Hi, I'm Robert Powell, editor of Retirement Daily, TheStreet's newest subscription product. I'm joined here by my co-host, Tracy Byrnes, and my guest, Jeff Levine, who is the CEO of Blueprint Wealth Alliance, and Douglas Boneparth, who is the president and financial advisor with Bone Fide Wealth. And today we're going to be talking about some evergreen topics regarding retirement. What are the key ages that you need to know, and what are some of the key dates on the calendar that you need to know? So let's start with, I think, one of the first ages that people need to know about is age 50. Should we start there?
Sure.
Is that a good age?
Absolutely.
What do people need to know about age 50?
Well, at age 50, that's when you can start putting more money into retirement accounts. That would be a big one. So prior to age 50, for IRA holders, at least in 2018, you have a $5,500 limit. Once you reach the year in which you turn 50 years old, you can put an extra $1,000 in. And the same rules apply also to 401ks, 403bs. There's additional catch-up contributions that you can put in once you reach that age. And it can really help accelerate you in those final years before you have retirement or hit retirement.
It's an extra $6,000 for your 401k. I mean, that's not chump change.
Not at all.
And given that most people procrastinate around retirement savings, this is a special boon, right?
It's a nice advantage. Compound that over several years and you'll find it working for you.
Right. Okay.
Yeah, and the other aspect of that that's really important is that once you hit 50, 55, maybe even 60, that's a lot of times when people finally have that money to spend. They may be paying off their mortgage before. It may be a time where they were paying for children's education. Exactly. And so that's also the time when all of a sudden people tend to have some more disposable income. So it's a great matchup of the ability to make those additional contributions and the legal tax ability to make those additional contributions.
Bob, you and I were talking yesterday about how, wow, 50, people should start thinking about power of attorney too, right? For your trust and, you know.
Yeah, it's a good time to sort of check in with your estate plan because, you know, goodness knows that, lots of things could go wrong, right?
Sure.
Mortality starts to rise and you get older.
I recommend every 7 to 10 years to be looking at your estate planning documents. Certainly on the younger side if you're having kids, and on the older side if you start having grandkids. So good to revisit that,
Right.
Not beyond a decade or so.
Yeah. So you turn age 50, and then that's the saving part. The two next dates that people have to look at are the dates by which they can start taking money out of their accounts, right? Age 55 and 59 and a half.
Sure, absolutely.
Yeah. So 59 and a half, kind of key date there. You've been putting all of this money away for retirement. You want to know when can you get it. 59 and a half is when you can take that money out of your retirement account penalty free. Now, depending on what kind of retirement account you have, there will be different tax implications. For example, if you have Roth dollars or after-tax savings, that money's going to come out tax-free. But if you have pre-tax money that you've put away in your 401ks or your traditional IRA, you're going to pay tax as ordinary income on that money. But again, no 10% penalty, which is great.
Right. And age 55?
That's right. That's the other big marker there because a lot of people have their 401ks, their 403bs, and they may leave work at 55, 56, as long as you turn 50 in the year that you separate from service. So, 55 rather, in the year that you separate from service. Right. So you retire January 1st of year X, but you turn 55 on December 31st of that same year, you can dip into your 401k, 403b once you separate from service and use that penalty-free. It's one of the exceptions to the 10% penalty rule.
And people will probably, there's very well going to be people out there who actually need that money.
Sure.
Absolutely, especially in transition from a job to a job or premature retirement, which isn't usually something that is planned on.
Right. I mean, actually, there's another
that means you were pushed out.
Something bad.
Nice knowing you.
I mean, there are other times when you can take out without penalty, right, for hardship withdrawals, too, which have no age, right? We should mention that, too.
So hardship withdrawals, I know you're teeing me up here and you're giving me that line because, Bob, no, you can't there's no penalty-free withdrawals for hardship.
Right.
That's actually one of the biggest misconceptions that people have is that when they take money out of their retirement account, they say, oh, it was a hardship withdrawal. There are a lot of things that might qualify as a hardship, such as if you have a lot of medical expenses or if you're disabled. Those you might consider hardships, but what a hardship distribution is, it's generally the ability to reach into a plan and take out plan funds that you otherwise don't have access to, generally while you're working and you're under the 59 and a half. But if you're taking that hardship distribution, unless you qualify for one of the other penalty exceptions, it's still going to be taxable with a 10% penalty.
But you got to pay it back. Like, I mean, people need to know that too, right? Like, you can take this money, but oftentimes your plan puts you on a loan, a payment plan to pay yourself back.
So I think it's important to separate hardship withdrawals from loans, and
Absolutely.
I'm glad you brought that up. So oftentimes it might be more beneficial, depending on what the interest rate is and how much you have in the plan, to actually take a loan against your 401k.
Right.
Because let's remember, if you take a loan from your 401k, yes, there'll be interest on that. Generally, not bad rates in
payable
most
to
plans.
yourself.
And payable to yourself, which is great, sort of, kind of. Better than the bank.
Absolutely. And if you do that, yes, you're going to be put on a repayment plan, typically 5 years. So out of your paycheck is going to come a 5-year repayment every paycheck. If you buy a house, it's 10 years, first-time home purchase. But it's important to, again, distinguish between the hardship, which would come out, you'd pay tax and penalty on. It's just access to that money, which is why you might want to actually consider that
there's
loan.
certainly limitations to the loans, but
Absolutely.
But you know, all things being equal, I'd take the
check out
loan
both
off
options.
that.
Sure, yeah. I mean, at a top dollar, unless you're talking about one of the rare times when an IRS, or rather Congress creates an exception to the rule, generally talking at a maximum of $50,000 for that plan loan. So if you're going to buy a house, that may not cover it.
Right, and it may be 50% of your plan asset.
Sure,
And so on.
Yeah,
exactly.
you need at least $100,000 in that plan
That's
to even
correct.
get the $50,000 there. Well, I think Jeffrey and I would prefer you don't touch your retirement money for virtually anything but retirement. We understand things come up.
That's right.
But try not to touch it.
Yeah, so we'll move on from leakage for a second. So there's another age, another misconception around the age 60 and Social Security. Many people think that you have to wait till 62 or 65 or FRA or whatever, but at age 60 there's another key age that people need to know about. Some people need to know about.
Yeah, Jeffrey, take this one.
Sure, absolutely. That's one of those times when if you, unfortunately, if you have a spouse who's passed away and you're able to choose between taking your widow or widower benefit from Social Security or your own benefit, you may be able to start accessing those widow benefits, you know, as a survivor benefit is really the technical name for it. But that's the case if you've, again, you were married to someone. Generally, you have to be married at least 9 months before they passed away. There are some exceptions for accidents.
No Vegas shotgun wedding.
Yeah, you know, if you have to make it look like the toaster accidentally fell into the bathroom.
I understand.
Do you generally recommend it, that they take it or wait?
You know, it really depends. Generally, what you want to look at is the survivor should coordinate that survivor benefit with their own benefit. And typically, unless there's a reason that that survivor may not live a long time, you generally want to wait to take the higher of the two benefits. So if you're the survivor and you've been the higher earner, you may want to start at 60 taking that benefit. Even though it's early and it's going to be lower, you're only taking that for maybe 10 years and then switching over to your own at age 70. On the other hand, if you think that the survivor benefit might be higher, you might tap your own at age 62 and then wait, because you can't take your own until 62. But then once you hit 66, where you can take that full unreduced survivor benefit, switch over to that and take the maximum there. So it's a matter of really figuring out what is going to be the higher long-term benefit.
And there's some calculators that people can use, but it's probably best to go talk to a CPA and crunch some numbers.
CPA, CFP, somebody who has knowledge of the immense Social Security. I mean, there's 3,000 core rules or something like that to Social Security.
And you've read the
I actually took the Social Security manual with me, true story, on my honeymoon to read. On my, I know.
You came back married.
That's what I was going to say. My wife actually
Someone
kept
made
me.
a joke and it wasn't
I have no
you're
life.
a keeper. No, it's fine.
But I think you make a great point. The Social Security rules, it sounds so simple. I get a Social Security check. It's so not that simple.
It's
so
really not.
complicated. And it's unfortunate. People are in their retirement. Like, you wait to
Well,
zing them with
and
confusion.
some of the decisions are irrevocable. So
Exactly.
once you make it, right, it's,
That's right.
it's done once and done.
One thing I want to point out too is, as much as us as advisors think about, well, what's going to bring us the most financial reward? Like, we're the ones like gaming it. We're like, all right, if we file and suspend, and this goes for all formulations of receiving benefit. There's a caveat here. You know, never ignore the actual need. Like, there are plenty of situations where, okay, there might be something that's financially more in your benefit by waiting, but if you need money, like, you know, we're talking about survivor benefits, we're talking about widowers. If you need this money, I mean, don't try and game anything. Let's, of course, pay some credence to the fact that this money will go to help people actually move on with their lives and pay for bills and things like that. So please balance those two concepts out so you can find out what's best for you.
But speaking of gaming things, for years people took our next age is 62, which is the age at which the early age at which you could take Social Security. For many years, 75% of people took it early, without regard for the ramifications, right? Permanently reduce their benefit increase, permanently reduce their survivor's benefit, right, et cetera, et cetera.
Absolutely.
And for years, people would use the Social Security break-even calculator, right, to say, oh, right, I'm going to take it because I'll never live to age 78, and it's my money, and I'll die, whatever.
That's
so
right.
I want it now, yeah.
Social Security took the thing down. thankfully, right? So people wouldn't use the break-even calculator anymore.
It's the worst question that people could possibly ask themselves. You know, I came here today, I had to take a train into the city, and my wife was nice enough, she drove me to the train station this morning. We took our car, and we have car insurance like most people. You know what we didn't do? We didn't say, boy, I hope I get into a car accident so I can break even on my car insurance, right? It's insurance. That's what, if you look, it's OASDI. The I in that acronym stands for insurance. It's meant to protect you in case you live a long time. So I actually hate that break-even question.
It's gone.
Yeah, it's the worst question
but
anybody
people still take it at 62.
They do.
Clients still ask for that, though. I have, back to what we were talking about, they want to know, should I file on suspension? Should I ramp up, and we'll get to 70 in a second, but at 62, they want to know, you know, where do I break even with this? And it pains me sometimes to say, yeah, if you make it to 80, 81, typically that's where I find my calculations breaking
somewhere
out.
around that range,
So what my question or conversation with the client is, how long are you going to live? You know, it's not quite the best conversation to have.
Well, it's also how long is your spouse
that.
going to live, because you have to think about it in terms of a household,
Yeah,
right?
I mean, just got that much better, so now we're talking about how long their spouse is going to live, right?
Right. Well, and that's the point. We have the percent of widows in this country that are living under the poverty line is huge.
Absolutely.
And part of it is due to the fact that someone took Social Security early.
Too early.
I would add two caveats. There are two comments to that. The first being, you know, when people ask about that break-even calculation, I say, you know, let's first start with, why are you here? What's your number one concern? And overwhelmingly, what's the number one concern for people in retirement?
I don't want to outlive my
That's right. I don't want to run out of money before I run out of life. So say, okay, let's suppose that you did delay until 70, and you die at 70 years and 1 day. Congratulations. You didn't outlive your assets, right? You didn't run across the number one problem.
You didn't spend enough when you were alive.
That's
That's
right.
another story.
But that's not the number one concern, right?
I broke.
You can only guard against so many things. The other thing that I think is really important to that is people, you know, Social Security, we've talked about, such a complicated decision process. If you could simplify that, especially for couples, right? The smaller earning spouse, or the spouse that earned less during their lifetime and has a smaller benefit, I should say, that's going to go away at the first death no matter who dies first.
Right.
So if they want to take some early, let's say, that's the person who should generally do it. Because no matter what, whether it's the higher earner or low earner, that check goes away. On the flip side, the higher earner should focus on when the second death will occur. Because even if that higher earner happened to die at 70 years and 1 day, if their spouse lives like 180, like Methuselah, they're still going to make out on the, you know, on the better side of the equation, because their surviving spouse is getting that higher benefit long after they've passed away.
Shouldn't the conversation at 62 be, why do you even need it? Why don't you go get a job?
So that kind of comes back to where I'm saying is, like, I always want to just get real practical and very realistic about what the need is.
Yeah.
Many people are still working during this time, and it's really not even an issue at all.
Sure.
Like, you're still making a great salary, getting benefits.
In fact, if you're working, you may not even get any benefit, even if you claim it, right?
But
Exactly. It's true, you're making too much money to even get the benefit.
The process is so arcane because a kabillion years ago, 62 was old.
Right?
It's not anymore.
That's the new 32. All right, maybe not that much.
And 32 is the new 2.
Something like that.
Either way, there's no reason for most people to stop working.
Yeah,
And most aren't, right?
And most aren't.
Well, I shouldn't say most, right? People who are in typical white-collar jobs are working, and people who are in blue-collar jobs where they're physical labor, you know.
Understood. Understood.
yeah.
Can't.
Two different approaches to this, right? I mean, if everyone had the option of where retirement was affordable and work was optional, you'd take it. Doesn't mean you have to stop working, especially those who love what they're doing.
Right.
That's right.
And the stats bear that out. People are claiming and still working.
You see the spectrum of
And the
that,
problem
right?
is you got an 8-year window, right, for most people is between 62 and 70. And it's not an all or nothing deal, right? Every month you wait is that much less. Either your Social Security benefit is reduced if you take it early or increased if you wait. So one of the things, so one of the things people should do is, instead of, don't think of it as this 8-year cycle. I have one client in particular, she wanted to take Social Security at 62, and I said, wait 6 months. And then we waited 6 months. She came back in. I said, can we wait 6 months again?
Nice.
And we waited. We made it all the way to 68 before she said, finally, I'm taking my Social Security. So
amazing.
breaking it down, you know, that's a better way to
Nice
go.
tactic, I like it.
So we have two interesting ages coming up after the 62, which is at 65 we can now take Medicare, but have to take Medicare. But FRA is no longer 65 for a certain group of people, right?
Sure.
It is now 66. So this is a weird point at which people used to say, oh, I take Social Security at the same age I take Medicare, but that's going
You
away.
have to double down on these two concepts.
Right.
And now you kind of don't. I think you can incorporate a lot of what we've said with, you know, again, 62, 65, 70, not an all or none strategy here. Just because you're throwing the ability to get Medicaid in here, does that radically change how we think about it? No, of course not. But it is an opportunity there where you can evaluate your health benefits and say, well, what's going to be
Right, but you should sign up because there are penalties for not signing up,
Yeah.
unless you have
That's right.
credible
If you're a
coverage.
large
and blah, blah,
coverage,
blah.
Correct.
yeah,
That's
exactly,
correct.
large
Yeah, yeah.
employer, yeah. That, and obviously 66 now for those younger, a little bit like us. You know, our full retirement age would be 67, and that's starting to gradually change over. Like those who are 60 now,
I think there's a question mark after it.
Yeah, right. Maybe 67 if it's going to be.
You guys are safe. My children aren't.
I'm not sure I'm even safe some days. Like I
We're a voting block.
Yeah.
Yeah, I think you're good. Right.
worry.
We're
If you,
I
the
can, tell
number
you,
one rule.
I can tell you this. We got you covered.
Well, thank you.
Yeah.
No worries.
You're welcome.
Yeah, well, and my children keep saying that. You mean my salary goes to your retirement?
right.
I'm like, that's how it works.
We pay it forward.
Well, what about the first Social Security recipient, right? Ida Mae Fuller. She
Yep.
didn't ever pay in. All of a sudden, she just was alive and said, "Wow, I'm getting money every
Money
month.
for me."
This is a pretty good deal."
It's true.
And that's one of
It's
the
true.
people think, and that's the other people think.
Back-ended.
I can't wait to take Social Security so I can get back my money.
money.
No, it's not your money. You paid. It was designed as a pay-as-you-go system, and
Yeah.
you know people think, "Oh, Social Security's broke. It's not going to be here. It's gone." There is a problem we have to fix, but
Yeah.
let's not forget that last year Social Security actually made money. We've got more than $2 trillion in the Social Security Trust Fund. It's okay at least for the next, let's say, decade and a half. And on top of that, there's this irrational fear that people have that it's just going to be gone. At the end of the day, let's say they do nothing, which is not going to happen, right? For the same reason you talk voting block, right? They have to fix it. But let's say they don't, and they do nothing. Doug and I are going to be working in 15 years. We're still going to be paying money into the system.
Thank God for that.
So that's
There'll be
78.
something.
Yeah, that's right.
My argument is there'll be something.
80 cents on the dollar.
80 cents.
Maybe
$1.
radically different, maybe a different scheme, maybe a different thing altogether. But to say, like, what it would take to get to nothing,
Not going to happen.
Well, then
way
they
too
need
extreme
to stop
of an idea.
borrowing against it. There is that.
Yeah, that would be a good idea, too. Yeah.
Yeah.
Just say.
All right.
we'll throw
All
that
right, we've
out
got
there.
$2 trillion of IOUs. That's maybe a better way.
So we did away with two of the tactics that people use to
That's right.
that would have increased the deficit, I think, in Social Security, right?
Sure.
But we'll forget about that. Many more people now are being told to. I've written these stories. You've written them. To wait to age 70 so that you can get the maximum, right?
Yeah, 8% a year, right? For every year you wait. I mean, that's some pretty good. That's a nice reward.
It's great reward.
It comes back to how long you're going to live, and can you actually start collecting that higher amount over a long period of time? I generally feel good about it. I'd love your opinion.
Yeah,
on it,
no,
but
I
I generally feel
agree.
good if you can afford
Yeah,
to
I'd
do
like
it,
to
and the
see
need's not there.
Yeah.
You know, I'd ratchet up 8% for 4 years for those from 66
Guaranteed
to 70.
return,
No
and then
question.
the
You
COLA.
know, if
And
it's good
on
health,
top-
I'd feel
right.
really good about it.
Right.
It's also a tax-efficient form of income because most money you get in retirement, whether it be from a pension or maybe it's your own IRAs, 401ks that you're taking out, generally they're pre-tax dollars, right? And every dollar you take and you remove from those accounts, you're adding $1 to your return at a minimum, right? And the flip side, if you take Social Security, if you increase your Social Security benefit, at a worst case scenario, you're getting 15 cents on every dollar completely tax-free. So it's a more efficient stream of income than most others. And even further, most studies show that if you were to compare Social Security to a commercially available annuity and benchmark them against one another, the commercially available annuity is never going to achieve what Social Security
No,
can
well.
with
Not
its
by a long
increases,
shot.
with its COLAs, and it's even more true in a low interest rate environment, which, although we started to see a little bit of a tick up, we're still in a low interest rate environment.
You like the IRR on those fixed annuities out there?
Yeah.
But I think that's
They're
why
robust.
too. Social Security needs to be also looked at as part of the big picture. And I know you're
Yes.
probably dying to get to required minimum distributions, right, at 70 and a
Always.
half. Always, right? So, but like, you need to look at that too, because those are coming. So another reason could be, it could be just another reason to put off taking the Social Security. When
Yeah.
you know you have these distributions, this IRA that you have to start taking from, that could be part of the equation.
Well, the thing is a good opportunity to say, now look, everybody is their own individual. You know, that'll come up
Right.
a couple
Holistic
times throughout.
plan,
Yeah,
sources
of
of
course,
income.
evergreen.
But it has to be
or-
everything.
Tax efficiency.
But the RMDs are very interesting because it can vary greatly for those who have small IRAs. And so let's first discuss what 70.5 is.
Whoa,
Required,
whoa, whoa,
yeah.
whoa. This is my favorite age. Hold on. I have to do the intro.
Oh, I thought we were there. I'm robbing you of this?
I tossed it.
Oh,
I tossed it. You
tossed
missed
to
that.
me. I missed it.
I thought
okay.
she was tossing it to me.
No, she was not tossing it to you.
Got greedy.
My favorite age.
Yeah.
What is it, Bob? Tell us.
Yeah.
Ages for 100, 70 and a half. What is 70 and a half?
Right. So 70.5.
Right?
Here we are.
Like, why do I have to remember 70 and a half? Like, of all the
Right.
cruel things that we have to
Weird
do
number.
to older Americans, right?
Weird number.
It is a weird number,
Yeah.
right? Oh, and by the way, at age 70, you have to take RMDs from your IRAs.
Yeah.
It's also
401ks.
the
Right.
most complicated year for RMDs because different age, or rather different time in which you have to take it.
Yeah.
It could be, you could have to start using the calculation using a life expectancy factor of a 70-year-old or a 71-year-old,
Right.
depending upon when the year. So it's like almost like having to go for your master's before you go for your bachelor's because it is the most complicated year.
And what
of
if you got to do
requirement
like 2 in
distribution.
1 year and the
That's
tax
right.
planning
Because that
around
sometimes
it?
does happen.
Right,
People
because
don't
you forgot
realize
to take it.
they
That's right.
might have
Yeah.
to do 2 in 1 year, then
And pay taxes
and
on
pay
it.
taxes.
Sure.
It could really blow out your tax
Right.
planning.
Yeah, push you into a
depending
higher
on-
bracket.
And also at that age too, I think people forget they could have inherited IRAs to boot, right? So
Well,
now,
they're taking RMDs anyway.
so they're taking RMDs
Yeah, they're
there.
out. Yeah,
you
yeah.
got RMDs potentially coming from your own. You got a
own.
lot of stuff going on.
And if you delayed Social Security, now you're bringing on
Right.
both of those forms
Yes.
of income.
Right.
You're taking the required minimum distributions, plus you've now got Social Security, which is why, even though we really didn't talk about it at age 62 or 66, you know, one of the things to throw in there is this might be an opportune time to start figuring out your distribution plan.
Right.
Yeah.
For instance, you retire at 66 and let's say you're comfortable. You're able to live off of, you've got some bank assets, you know, a bank account or other accounts. Maybe spend those down. Keep your taxable income at almost nothing. At the same time, you might be able to take money from a retirement account like an IRA and start shifting it into a Roth IRA where you're not going to have to take required minimum distributions and where ultimately it will be potentially tax-free coming out. And now when you turn on that Social Security stream of income, your RMDs are less. You kind of smooth out the income
Yeah.
over those years.
It's so interesting, and when we get to the planning side of things, you know, we always see these. Let's put people in buckets. You know, the buckets where like there's almost no tax plan. You're gonna take your RMD. Here you go. You know, do you want to reinvest it or do you want to spend it?
That's right.
Most of the time, they say you send me the money, right? And then you have this wide array of people who. You have these competing taxation factors coming into place. Like you think like, should I take money out of something that's growing tax deferred earlier? Well, yeah, if you're maybe not maybe you retired and there's no income coming in. But then what happens if you do is these little triggers that can really impact one's tax planning.
Absolutely.
And again, emphasizing the planning here.
Right.
It's
Well,
anyone's
that's-
game.
Right, and so that's the key to having like all these accounts set up long before you get to the
That's
point,
right.
right? To
Right.
think about, I need a Roth, I need a tax deferred, I need a taxable.
The tax
right?
triangle.
That's right. The same way we talk about investment diversification, it's tax diversification because who knows what the future will hold. We might very well today be in the lowest tax environment that we will ever see in your lifetime, in our lifetime, in
Which
our
all the
children's
more,
lifetime.
right? People should really consider that Roth. I
Absolutely.
mean, your heirs would be tickled if you pass on a Roth to them because they don't know tax on that.
It's like tax insurance. You
Yeah.
know, again,
Yeah.
I hope that rates go down and I'm wrong and we put in all this money into a Roth and, you know, it didn't work out because it means all my other money is worth more.
Fine.
But what if tax rates go up? What happens then? So that Roth really provides that buffer and so many risks in retirement, right? What will the market do? How long will I live? What will interest rates be? What is inflation? If we could just pull one risk, which is what are taxes going to be like,
Right.
off the table for at least a portion of someone's assets, that's a
Yeah.
huge benefit.
So that speaks to two things. One is obviously the need to create tax-efficient income in retirement.
Sure.
Take some sophisticated knowledge and people to help you. Is also the tax-efficient saving side. Now that we live in a world we have HSAs, Roths, Roth 401ks, right? Traditional 401k. Now the order in which I fund these accounts matters too.
Sure.
Right.
Absolutely.
HSA first, or traditional first, or Roth
Absolutely.
first. Do I get the match? Or it's no longer just like save money for retirement.
Yeah, anytime you start to put more pieces to the puzzle in place, you get more combinations, right?
Yeah, it keeps us in business too, right? Job security.
Job security, exactly, yes, yeah.
Well, it cuts both ways. It's great for people who have more vehicles in which to put money away and save, and it's great for us because it's got more complicated and they need to figure out, well, what to do there. But I think, you know, we're finally putting ourselves in a position where we can really benefit from the fact that we have a lot of these things. And once again, back to needs. Like, if you're young, you have young kids and family, you know, my medical expenses today, hopefully if I stay healthy, are going to be more today due to the fact that the family's growing than they will then. So HSAs or dependent care, FSAs all start becoming really valuable. I mean,
Absolutely.
there's amazing tax savings we're getting. Just I'm sending my kid to daycare anyways, so I'm going to fund that almost, dare I say, before our 401k. Yeah, probably. It depends on what
potentially,
your goal priority is. If you're saving for a home or paying down student loan debt and have a little kid, I've seen a lot of young clients of mine punt saving for, we're here about talking about retirement, they're punting that just because, and I'm not complaining. I'm not saying, hey, that's a bad idea. Who am I to tell them that their priorities here are wrong? But look how many more options there are today for people.
So we, couple more minutes, but any other dates, ages that people need to know about?
There's always more. We
Yeah.
could go on forever. We could talk about
Endow
75,
it at 100,
yeah.
So let's get some dates on the calendar that people need to know
Sure.
about. April 1 sort of comes to mind, partly
Absolutely.
because we were just talking about RMDs, and you need to take your
Very
last year's-
first. That's right. If you turned 70 and a half last year, then you need to take your very first RMD by April 1st this year. If you haven't already done so, that's a key marker in the
And
year.
be sure to use the account balance from 20
prior
16.
year.
That's right.
Right.
If you're,
27.
that's
Right.
exactly
December
right.
31st valuation
Yep.
prior year.
And of course, you have a lot of key dates towards, keyed toward the end of the year. October 15th this year, a very important deadline, will be the very last date that someone can recharacterize a Roth IRA conversion. That's a
Did you see? Did you in practice see a lot of recharacterizations? I'm curious.
Yeah, sure.
You did?
Yeah, we do
Interesting.
quite a bit of that. Yeah, I was really. I
Market's
actually
going up.
thought they actually wrote that law for me because taking
See what
advantage
it
of
is
all the
again.
loophole. Yeah.
Just so people know, that's taking your IRA, putting it into a Roth,
That's
paying
right.
the tax implications now, basically, so that the money can grow tax-free. I think it's it's an amazing tool.
But
You
then-
can still
but
do
then-
it.
and
You
you
just
can
can't
still do it.
undo
But then
it.
going
Can't
back
undo it.
And
the
then
other
going back
way.
the other way when you realize the market
Right.
fell.
Exactly.
So it
that's-
used to be
that's
pretty
right
sophisticated,
there.
right? You'd put a small cap IRA over here,
That's
a large
right.
cap IRA over here, and then whichever one fell in
Right.
value, you would, right?
It was kind of cool little option.
It was great
Yeah, it was
for those who got to do
so much planning you could do. That's gone.
But that means you're gonna be
I'm
busy
gonna
up
start
until-
crying. Hold
yeah.
on.
but also interesting in an environment where we've seen things relatively go up. That's
That's
why
right.
I asked the question. It's like, well, what did poorly,
So a lot of the times it wasn't even what did poorly, it was what just didn't do the best, right?
Got
so
it,
we would
got it,
take,
got
say the client should have 200,000 converted. A lot of times we would convert 4 different things. Rather $50,000 converted, we take 200,000, put it into 4 different IRAs and say, hey, which of these did the best? Maybe they all went up, but one went
Yeah.
up more than all the others, and we just get rid of the other 3 that weren't as good. That sort of higher, like sophisticated planning, which was a lot more paperwork, but allowed the client a lot more flexibility, that's gone.
Client doesn't mind signing things to make or save
That's
money.
right, yeah. They're very happy to
And
do
to
that.
avoid
and I got
taxes.
to tell Tracy about private letter rulings yesterday, so we're up to speed on
Yes.
that.
Boy, you guys must have had a really exciting
we were,
day
yes,
yesterday.
we were
Almost as
rolling.
exciting as
Well, I
your
was going to
honeymoon.
say, yeah, you all,
Rolling.
maybe I shouldn't be here.
All right.
I don't know.
What about quarterly taxes? I mean, people, if you're about to retire and all of a sudden you've never had to pay quarterlies, but you might in going into retirement. You have
Yeah,
an
so
issue with that?
those running their own business are very familiar with paying their quarterly
Absolutely.
estimates, but those who are going into a very different tax regime, or such as about to retire, are going to say, well, what is this? You no longer have money coming out of paychecks, right? That's where your withholdings are. So in that particular year, or as a business owner would call it, every year, you're going to make quarterly payments to the tune of pretty close to what you paid in the prior year, for simplicity's sake. I'm sure you know the numbers by heart. but-
Yeah, so it's generally 100% of what
yeah,
you
10% of what you did, or 90%
Yeah.
of what you think you're going to make.
That's right.
So just pay the 100%. You've
But
got
it's
something
not
to worry
just
about.
it's not just Social Security. I mean, it is if we are talking about people that are taking on jobs in retirement. Now you have Uber drivers or Lyft drivers,
Yeah.
right? Now all of a sudden you have this gig economy. These
It's
guys,
real.
these people don't realize that they owe
Yeah,
taxes
you might
now.
have an earned income, IRA distribution, Social Security
and
coming
you're
in.
probably going to need to make estimates with that as well on that income.
You certainly have to account for the taxes. Sometimes you can get away without actually making the estimates and make your life easier.
And just pay the penalty.
Well, hopefully not. That's one option, sure. But let's say you have to take like a $10,000 required minimum distribution. There's nothing to stop you. Let's say you have income from another
Yeah.
of different sources. Just saying, you know what? I was supposed to pay in $2,500 estimates throughout the year each quarter for $10,000. Instead of sending me my IRA distribution, my RMD, just 100% withhold it, and that will actually be treated as being paid in ratably
good
throughout
point.
the year.
That's a
And you're
good point.
done. You don't have to
Yeah.
worry about 4 checks. You don't
That's
have to worry about
presuming
anything.
you don't need the money.
And it's presuming
right.
you have the see, the thing is, you need to have the knowledge and understanding, which is why I liked your point a lot here. That's why we're doing this here today. You can watch and find out, hey, these things exist, and you're going to
right.
have to take action on them. The last thing in the world, we call them love letters, the last thing in the world you want is that love letter
Yeah.
From Uncle Sam.
or the state,
You know,
or
and
all of them.
Yeah.
What drives me crazy, and to the point you just made, is we all play by the same set of rules, and yet there are some people that end up with a lot more because they're able to, either they take the time to research or they're able to afford the right type of advice. And our system is just, it's just a reality. Our system is so complicated that those who do that will often end up better off than those who don't pay attention. You know, study after study shows the more you focus on your finances, the more money you will have. So, you know, just just listening today, chances are somebody picked up something
Yeah.
that will,
Because
save them a little bit here or make a decision there.
We're putting dollars in pockets, people.
Yeah, well, I
There you
mean, that's
go.
our hope, is to get people from sort of street level to curbside to maybe advisor's doorstep, so that they at least, their eyes don't glaze over when you say, oh, we want to delay Social Security for this reason, or we have to pay quarterlies, or...
There are a few things in life that can practically and radically change your life, and personal finance is one of them. So just getting a little bit of content and a little bit of knowledge, seriously, could start changing your life or something good. I believe in that.
All right, well, I think that brings us to the end of our segment. On behalf of my co-host, Tracy Byrnes, I want to thank Jeff Levine for coming, and Douglas Boneparth. I'm Bob Powell, editor of Retirement Daily.